Hello and welcome to my YouTube channel. My name is Joris and welcome to Joris Invests. Today I'm going to talk about our core satellite strategy, and in parentheses you can see that it says to be. So my wife and we discussed quite a bit about which stocks and ETFs we are going to include into our strategy in the future, and I want to present this strategy to you today. And as it says, it's the core satellite principle that we are going to apply. So what is it? So you have the core, and it compromises more or less 60 to 80% of our portfolio, and it's going to be invested in index funds, and it's going to be for the long term. And then of course you also have satellites, so they will compromise 20 up to 40%, and yeah, it can be different kind of things. So it's more flexible. You can invest in funds or in stocks, of course. And when it are stocks, then they are more active, and they can be also shorter time horizon. But for my wife and we don't care about the shorter time. For us, it's the long term that counts, because we like dividend investing and seeing our dividends grow over time. That gives us the motivation to continue. So for us, that's the more important thing. So the core are index funds, and you have ETFs or exchange traded funds versus mutual funds then. And yeah, you can see it here in the table. So both ETFs and mutual funds, they follow an index. They also are well diversified. Okay, you can have ETFs or mutual funds that don't invest in a lot of stocks, but still, when you want to invest the same amount of money in stocks, you can only buy two or three at most when you start investing. When you start, for example, with a lump sum of 5,000 Swiss francs or euro, and you want to buy stocks, you are not going to buy 100 francs of every stock so that you have 50. No, you are going to buy for 1,000 francs because it's more cost efficient to do it. In my previous videos when I talk about this, you have to have the right broker for that to be able to buy cheap. And don't forget, every time when you buy something, it eats in your profit, because it comes with costs. And cost regarded, so you have the ETFs, which are most of the time passively managed. 5% more or less are not passively managed but actively. And you will see it in the TER ratio, and that's the total expense ratio of the fund. So on the Swiss Stock Exchange, the average TER is 0.45%, 0.50%. So the most are around that percentage, some are below, and some others are quite high above it. It goes even up to 1.5, 1.7% for an ETF, because it's actually actively managed. And then you have mutual funds. Most of the time, those are actively managed, so only 5% are passively managed. And then those ones are cheaper, but most of the time you won't find them cheaper than 0.50%. And most of the time they are around 1.5 up to 2.5% total expense ratio. So that's a really important thing to consider when you look at ETFs versus mutual funds. The intraday pricing on a stock exchange, that's also really important if you want to be flexible to sell your ETFs or buy your ETFs. That's possible on the stock market, and you can see the actual price forming taking place. So you can look at the orders on book, and you can adjust your order according to that if you want to buy immediately or just work with the limit. Mutual funds are more difficult because the price is set only once a day. Most of the time it's after the closing of the American stock market that the prices are calculated, and then the next day they are published, and overnight your orders are filled. So you don't know beforehand what the price is going to be. And if you want to work with limits, that's a really difficult thing with mutual funds. So that's why I prefer investing in ETFs over mutual funds. When I was younger and when I first started out with investing, there weren't ETFs around. So my first funds that I bought was a mutual funds, and after the ETF started, I sold immediately all my mutual funds and bought an ETF instead, because the difference in the TER ratio is so high that it's actually ridiculous that mutual funds are still around. But everybody has its own preferences, of course, but mine and my wife's is definitely ETFs. So it looked like this for us. So the ETFs, they comprise 70%, and it says ETFs because the core can have more than one ETF, of course. And then the rest is the satellites that float around it. And sometimes it's difficult to see because in the plan that we are going to propose here, so there are some ETFs that are in the core that only comprise 5%, and then you can say, yeah, maybe you can consider that a satellite as well, but I will explain why I say that. So what about the satellites? Do they need to be individual stocks only, or can they also be ETFs? Well, I already answered that more or less. So for me, they can be both, and it's up to you. So if you like investing in stocks like me, then of course you can buy a lot of stocks. Even if you can handle it, you can have a stock in your core for the core satellite plan that you apply. But for us, because yeah, we are with two, of course, and my wife isn't that risk tolerant, we only invest in stocks as satellites. And for stocks, it's really important. I'm a value investor like Warren Buffett and Charlie Munger, and they always say you need to understand the company, so you really need to know what they do. You have to know that the company has a durable advantage compared to its competitors or new firms that want to occupy the same niche as your company in which you want to invest. You have to like, trust, and believe in the management of the company. When you don't like the management, don't invest in it. So that's really important. And then, of course, it's the price. On the stock market, you don't have a lot of choice. You have to pay the price that is currently available on the market. But when it's too high, you can decide not to buy it. Warren Buffett and Charlie Munger, they have of course the luck that they have a lot of money, and they can go to companies, or companies even go to them to propose to sell their company to them, and they can also buy companies privately. So for us as particular as as just normal people, we are only able to buy stocks on the stock market. So when the price of a stock of a great company that you understand, that has a durable advantage, and the management is great, but the price is just too high. So the price to earnings ratio is 25. That's too much. You should wait until something happens, till it drops below 15, and then strike. So it's also important to keep money aside when it's possible, because on the other hand, yeah, you want to be invested with your money as fast as possible so that your compounding can start as early as possible. But on the other hand, sometimes it's handy to have 2000 francs aside to be able to grab up some couple of shares of companies that you really like. And then, of course, ETFs. You have to like and believe in the index it tracks, and of course, they have to do the thing that your main goal is. So, for my wife and I, it's dividends. So, when we look at ETFs, it are only ETFs that also distribute a nice dividend, and most of the time pay out quarterly, because yeah, when you receive every 3 months, you receive money from your ETFs. That is a lot more practical later on when you retire, but also for letting your money compound faster. So, and it's also a motivator. So when you are investing and you are only investing in ETFs that accumulate everything, you're going to see the price rise, but in downward trends on the stock market. And the last year and a half, it's more or less like that the stock market is going sideways, but actually always dropping a bit. It are only on every stock market, it's only about 10 or 15 stocks that really perform good and keep up the indices of those stock markets. But the rest of the stock market is actually dropping. So in Switzerland, it's the same. There are 10 companies that are performing really good, and they are outperforming the rest of the stocks on the Swiss stocks exchange by a lot. So if you invested in those other 600 companies that are on the six, then you're probably in the minus right now. If you invested in those 10 others, it can be that you are still positive. So the thing about dividends is, if you then can look at your yearly dividend being paid out or your monthly dividends being paid out, and you can still see a rise there, that keeps you motivated. And yeah, it's really important that you have that kind of motivator to keep on continuing with investing, and that you don't think, oh, it doesn't bring a thing. Now I add 1,000 francs this month, but yeah, my portfolio of 100,000 francs, it dropped 3%, so I lost 3,000, and now I add 1,000, so I'm at 98,000, but I should have been on 101,000 Swiss francs. If you have the dividends to look on, that is really an important thing. So don't forget about that. So how does it look for us? Our plan. So we have 3 stocks. So we have a stock that is compromising more or less 4%. It's going to be 4%. Another one that is going to be 3%. Another one that is going to be 3% as well. And then we have 10 ETFs. And you can see 5 ETFs are on the bench. So from all the ETFs, it's 1,700 ETFs that are on the 6 stock exchange. My wife and I, we selected 15 that are more or less interesting for us to invest in, and from those 15 we picked 10, and maybe one of those 10 are going to be changed into one of those 5, but we don't know for sure yet, because the distributions that we have right now are really nice. So we have in the core, we have GLDV 20%, SDGPX 30%, FLXD with 10%. So GLDV, SDGPX, that are global funds, VHYL as well. So three global funds. FLXD is actually a fund that invests in Europe, and CHSPI, that's a fund that invests in Switzerland, in Swiss stocks. And as you know, we also have the ETF CHDVD, but those are solely for our daughters. So we only buy CHDVD for the saving plan of our daughters. So that's also important that you know that. The DVD, I like that more over the CHSPI. It brings more as well, but yeah, when you only have two good dividend stocks, dividend ETFs for Swiss companies, when you're living in Switzerland and you have daughters to save for, you take the best one for your daughters, of course. So, and then we have the other ones. So QYLD and XYLF. I will talk about those at the end. But then we have Wene, that's a fund that invests in energy sector. EMHD, that's emerging markets fund. And then the TRET, that's the real estate fund. And they are all going to be 4% of our portfolio. And the QYLD and the XYLF, I think when you know what they are, you will say, hey, Joris, you said you don't like swap-based ETFs. And indeed, I don't like swap-based ETFs. But for those two, I make an exception. Yeah, I know. But so they both invest. So the QYLD, everybody, when you look at YouTube, normally you should already have heard this name. It's the same name as so the same ticker as the QYLD fund that all the US investors are talking about. But this one, in fact, it notes on the SIX stock exchange. So all the ETFs that you see right here, they are noted on the SIX stock exchange in Switzerland, and this one as well. And it has a easing code that starts with EE, so it's from Ireland, Ireland situated. So it's not a US ETF; it's a European ETF that notates on the SIX, and it's the Nasdaq 100 covered call of Global X. And this one, of course, is the S&P 500 covered call from Global X. So that's XYLD for the US investors that are watching this channel. So in those two, my wife and I, we agreed that we are going to put our money in those for tracking the US stock market and profiting as well from the high dividend yield that it brings. So momentarily, we are not there because SDGPX is highly overweighted in our portfolio right now. And of course also our three stocks that we have, because we already have those three stocks. And the plan is for the next 2-3 months to invest in GLDV and VHYL, and also to buy FLXD and of course VHYL. So this month it will be, at the end of this month, it will be FLXD and VHYL, and then next month it's going to be GLDV and VHYL, and then in January it's going to be the two funds from USA, because I don't want to have to fill in our tax return next year with those two in it after they already gave dividends for a few months. So the XYLF, I think it's already for over a year on the 6th, but this one only from June. So it started recently notating on the SIX stock exchange. And yeah, tax returns and filling it in, it's always a bit tricky. So I'm going to wait until January to buy into those two funds. So that's the plan for the next 3 months. By doing that, the amount of SDGPX and the percentages of the stocks will drop, of course, because I'm not going to contribute in the SDGPX the next few months, which is actually a bit of a shame. But yeah, it's the way it is. So right now we have those three stocks and these three ETFs already. So in the coming months, the FLXD and the QYLD and XYLF will join the other three ETFs that we already have. And then in the following months, the other three will follow as well. And of course, the CHSPI will be coming as well then. So the 5 core ETFs. So why are they in the core? Because you saw this one is 5% and the other one is 5% as well. Why are they in the core and not as satellites? Because in the core we invest Swiss francs and euros, so no dollars. But we receive Swiss francs, US dollar, and euro as dividends. So GLDV, SDGPX, I'm going to start with the 30%, of course. So that's euro to euro, and it's distributed dividends in the first, the fourth, the seventh, and the 10th month of the year. Then the GLDV, the Spider S&P Global Dividend Aristocrats ETF, that is investing in Swiss francs and gives a dollar dividend, and it distributes in February, May, August, and November. And it's 20% because at the end, in the one of the final slides of this, when I'm discussing that, you will see why this is 20%, because it's really difficult to find ETFs that distribute in these months. Then the FLXD, so euro to euro again, just like the SDGPX, but this one is global, this one is Europe, and it's going to be 10% of our wallet. Then CHSPI, the core SPI iShares for Switzerland, so Swiss franc to Swiss francs, and it distributes in March, April, May, and July. And then the last one, the Vanguard fund, also a global one, Swiss francs to dollar, just like the GLDV, and also in March and June and September and December, like the Franklin European Quality Dividend. And then the 5 satellite ETFs plus the 3 satellite stocks. I'm not going to say which stocks we own because that's a dangerous thing on YouTube. I'm not a financial advisor, and even though I'm really convinced that the 3 stocks that we own are really are really good, um, those stocks may not be the stocks for you. And on contrary to some of the YouTubers from America and the UK, where they give all the names of all the stocks that they own and they discuss the stocks. I'm going to discuss stocks for sure, but I will never say which stocks that I have in my portfolio to not influence you. I'm just going to say which ETFs we have, because ETFs are always diversified, they come with less risk. There is certainly risk involved with the ETFs, but they come with less risk than stocks. So I will not be saying stock names on my YouTube channel. Then we have the QYLD and the XYLF fund. So that's Swiss francs to dollar, and they are not in it, although it's Swiss francs that we invest. They are not in the core because they are covered call ETFs and yeah, swap based. So I'm not a fan of it, but I'm a fan of their dividend yield. Then we have the EM HD, so the emerging market fund from Invesco. I really like actually a lot the ETFs from Invesco. On the other, I I could have mentioned more Invesco funds than than the amount that we have now in our wallet because yeah, Invesco they really have a lot of good ETFs, but unfortunately most of the time they are dollar to dollar, so it's not that interesting for our portfolio. But for the emerging market, they really stick out. So it's a small fund, but have a look at it and form your own opinion on it. But my wife and I, we are convinced that this one is a really good fund. Then the energy fund, also from dollar to dollar, the iShares MSCI World Energy Sector ESG. You also have from iShares the same name, except the ESG is not behind it. That has 3 times as much money under its belt to manage. But yeah, the ESG principle, it's really important for us. But yeah, I need to make a video about the ESG labels for ETFs because when you look at the values of the ESG score of this ETF, they are terrible. They are better than the other fund, for sure, but they are still terrible. So I hope that yeah, it improves the ESG label because for now, for us, it's really crappy. And we went for the ESG because the scores of this one are much better than the bigger fund of iShares for the world energy sector. But yeah, it's a hard one. And then you have the TRET, Van Eck Global Real Estate. That's also Swiss francs to euro. But this is a satellite because we aren't sure about this one. So for now, it is in here. And it's nice that it converts Swiss francs to euro. But on the other hand, it's a Dutch based ETF. And I don't like the fact that you have to fill in extra papers to get the 15% back that the Dutch government always keeps for themselves. And yeah, it's a hassle. That's why we don't have in the core the TDIF ETF as well for the global dividend funds. We used to have it in Belgium. There it was easier, but yeah, here in Switzerland you have to fill in the form, you have to get it back, and then when you fill in your taxes, it's because you contribute multiple times over a year. It's not that easy to calculate everything, and that's why we prefer the German one as the GPX, the Irish ones. Almost all the other ones that I mentioned here are Irish, except the Van Eck. That's Dutch from the Netherlands. So the German, the Swiss, and the Irish, they are much easier for the tax return, filling in the tax return. So that's why we prefer that. The Van Eck Global Real Estate, it's a really good ETF. So we are still in debate about that. And it's going to be probably the last one that we are going to buy next year. And if we are going to change it, I'm going to keep you updated. I'm going to keep you updated about the percentages as well, where we are, so that you can follow where we are more or less. And then how does the diversification of our plan looks out for the ETFs that we have in our portfolio and that we are going to have in our portfolio in the future? So for the investment contribution, so as we earn Swiss francs, of course, that needs to be the highest amount. And then for the euro, it's going to be 40% of the money that we invest in the stock market. And then US dollar, it's going to be 15%. But what we hope is that the ETFs, so 50% of our ETFs are going to distribute dollars to us. And we hope that this 50% more or less covers the 15% that we need to contribute into our portfolio so that we don't need to buy extra US dollars. And the same amounts counts then for our euros. So we hope that over time we don't need to convert Swiss francs to euro anymore to make the contributions into our wallet. So, but for now, we should certainly have to convert Swiss francs to euro all the time when we want to buy SDGPX or FLXD. So for now, we can't escape the costs coming with that. And then, of course, the poor thing about being a Swiss investor is that you have so few good ETFs that you can invest Swiss francs into and receive Swiss francs, that we will only receive 5% of our dividends in the form of Swiss francs. So, and in fact, it's going to be a bit less because the dividend percentage of the Swiss ETF is a lot lower than the average dividend distribution of our whole portfolio. So I think it's going to be, yeah, more or less 4.5%, because the two stocks of that we own also distribute Swiss francs. So that's also a nice thing. And then the diversification. So the core, it's 70%, and then we have two satellites that invest in the USA stock market, so 10%. We have an ETF that invests in the emerging markets, 10%. The energy sector, 5%, and the real estate sector, 5%. So 70, and then the satellites comprise 30%. And then region-wise, so worldwide, it's 65%. So that comes from the core plus the energy and the real estate, because those are global as well. And then the AU, that comes from the core. So the FLXD ETF has 10% of the core, and that's the EU region. And the USA, it's already here, 10%. Emerging markets, 10%, it's also here. And then Switzerland, it's the CHSPI ETF that's in the core, that gives us exposure of 5% to the Swiss stock market. And of course, the world ETFs, they also have USA stocks, more or less 30% in it. Also EU stocks, emerging markets, a few, but Asia as well. So from the Asia region or the other BRIC countries, so they are also present on in the global ETFs. And some of the global ETFs also have a few percentages of Swiss stocks. So if you look at it, it's a nice distribution, I think, over the whole world. And then, as we plan on living on our dividends for a part after we retire, of course, it's important that the distribution of our dividend is even. So when you look at the dividend payout in the first 3 months, it's 40%, 30%, and 45%. April, it's 45, 35, and 45. So you can see already the problem with February, May. So here it is okay, it's 35%, so it's over 1/3. But getting this one up, that was the difficult thing. So that's why we bumped up the GLDV up to 20%. And together with the QYLD and QYLF funds that distribute monthly, 30% of our portfolio is going to distribute of our ETF portfolio. That's what I need to stipulate, of course, is going to distribute um, a dividend in that month. For July, August, and September, it's 45, 30, and 40. And then the last 3 months is 40, 30, and 45. And on average, our ETFs are going to give a dividend yield of 5.21%. And that's, of course, with the current prices. And most of the ETFs went down in the past year. So yeah, it's a really nice dividend yield for now. It's going to go down for sure. When the stock markets go up, it's going to go down to around more or less 4%. And 4% is what my wife and I are aiming for, because that's the the thing that when you invest 300 Swiss francs or 300 euros or $300 into the stock market and you receive 4%, that you get 1 Swiss franc, 1 euro, or $1 back for in every month of the year for the amount that you invested in the ETF. So that's our aim, and I think we are on the right track. And then for our main goal, so our main goal is to have a dividend, to receive a dividend of 3,500 Swiss francs every month. So of course it's difficult with the US dollar and euro that we will receive. We have to do the recalculation also with the tax in mind. But this is pre-tax. So with our other pillars, so the first pillar, the second pillar, and the 3A pillar, normally together with this amount, we will be able to live a nice life here in Switzerland when we retire. And now we have almost 175 Swiss francs per month in dividend. So we are 1/20th on the way, so 5%. And as an old Chinese saying says, even a journey of 100 miles starts with a single step. That's how we started a few years ago. So investing 300 Swiss francs, in fact 300 euros, because it was as a GPX where we put our money into. There we started with baby steps, and now we are on our way, so 5% there, 95% to go. But with that being said, I want to thank you for your attention. Thank you for watching. And if you like this video, please subscribe and see you next time on my YouTube channel. Bye.